Following the initiation of Operation Epic Fury and the targeted assassination of Iranian leadership, Tehran retaliated by declaring the Strait of Hormuz closed. Commercial shipping traffic is now dead in the water. Yet global equity markets are projecting total complacency. The VIX, a real-time index that measures the stock market's expectation of near-term volatility, remains suppressed, and the S&P 500 is trading as if this is a minor regional skirmish. This reaction stems from a specific mathematical error in the oil market's pricing model. Traders are currently assuming the disruption is limited strictly to the loss of Iran's own 3 million barrel per day export capacity. This institutional risk briefing directly contradicts the market's consensus. It identifies the Strait of Hormuz closure as the largest energy supply disruption in history. The analysis assigns a strict 45% probability to a 2 to 4 month protracted conflict scenario. This probability table reveals the severe tail risks the consensus is ignoring. Models allocate 35% probability to a protracted conflict and 15% to an escalatory spiral. Combined, the market systematically underweights a 50% coin flip risk of a severe economic shock. By treating a massive structural supply deficit as a brief, localized disruption, institutional risk models are effectively flying blind into an unmitigable crisis. The United States and Israeli military doctrine relies on achieving regime change through precision decapitation strikes, specifically avoiding the commitment of ground forces. The historical record shows this approach consistently fails. Multi-day air campaigns successfully target leadership, but they do not collapse the underlying state security apparatus. The immediate structural outcome of these strikes has been the rapid consolidation of power by hardliners, specifically the new supreme leader, Mojtaba Khamenei, operating under a strict mandate of existential survival. This survival mandate has crystallized into a new primary strategic objective, the nuclear imperative. Iranian leadership observed the fates of Libya and Ukraine, concluding that giving up nuclear ambitions in exchange for security guarantees invites invasion. Conversely, they see that nuclear deterrence forces global superpowers to negotiate. The previous religious edicts issued by Ayatollah Ali Khamenei that forbade the weaponization of nuclear material effectively died with him, removing the last ideological barrier to total enrichment. Game theory dictates that an immediate, accelerated sprint toward a nuclear warhead is now the only rational move available to ensure the regime's permanent survival. Rather than neutralizing a regional threat, conventional decapitation strikes have structurally guaranteed a highly volatile acceleration in nuclear proliferation. Facing overwhelming conventional military inferiority, Iran's dominant counter-strategy relies entirely on asymmetric warfare and active cost imposition. Tactically, this involves striking the infrastructure of neighboring Gulf Cooperation Council, or GCC, states. The GCC is a political and economic alliance of 6 Middle Eastern countries, and targeting them forces neutral parties to suffer immediate economic pain. This horizontal escalation across the region is engineered with a specific goal: forcing these wealthy third parties to leverage their influence and pressure the United States into accept a ceasefire. The United States military also faces severe financial attrition. A single Patriot PAC-3 interceptor missile costs between $3 and $5 million. The Iranian Shahed drone it shoots down costs just $20,000. This document maps the standoff like a game of chicken. If both escalate, a mutual crash results. A mutual deal is optimal, but political constraints force rejection. This traps both in a Nash equilibrium, a prolonged stalemate, enduring pain rather than surrendering. Iran operates with a high threshold for economic pain, while the U.S. administration faces a strict political deadline before the 2026 midterm elections. Because of these asymmetric incentives, the market's assumption of rapid de-escalation is game theoretically invalid. Setting geopolitical theory aside, we have to look at the hard, physical infrastructure of the global energy supply chain. This graphic shows the baseline volume of energy transported through the Strait of Hormuz. 20.3 million barrels of oil and 20% of global liquefied natural gas trade rely exclusively on this maritime transit route. The market has miscalculated by pricing this disruption as a localized event, accounting only for the 3 million barrels Iran exports daily. The true physical reality is much worse. A functional closure of the strait halts the full 20 million barrel per day flow. We calculate maximum mitigation from alternative routes, specifically the Saudi and UAE pipelines. Combined, their maximum bypass capacity is 6 million barrels per day. Subtracting that leaves a stark, unmitigated global supply deficit of exactly 14 million barrels per day. To counter this, the International Energy Agency announced a historic emergency response: the coordinated release of 400 million barrels from the Strategic Petroleum Reserve, an emergency stockpile of crude oil maintained to absorb supply shocks. The exhaustion mathematics are straightforward. Divide that 400 million barrel reserve by the 14 million barrel daily deficit, and the entire global safety buffer is depleted in exactly 28 days. Deploying emergency reserves during an unresolved military conflict triggers secondary market effects. It introduces a scarcity premium, prompting massive physical hoarding by highly vulnerable importing nations like China and India. This table runs the Monte Carlo probability simulations for crude prices. Against the market's base case, the quantitative estimate shows a 65% chance that oil remains above $100 a barrel for at least 3 months. Finite strategic reserves cannot bridge an infinite structural deficit. Once the SPR buffer is exhausted, a violent physical repricing in the oil market is a mathematical certainty. This chart analyzes historical energy shocks to identify where an oil price spike becomes a recessionary growth shock. For the current Hormuz crisis, this transition threshold is breached if Brent crude sustains at $125 a barrel for 8 weeks. Once that threshold is crossed, second-round effects propagate through the global economy. Supply chain costs surge, consumer confidence collapses, and corporate margins compress simultaneously. Central bank models currently assume this is a temporary inflation spike, allowing them to keep interest rates on hold. But once the growth shock takes hold, these models break, forcing a panicked pivot to emergency rate cuts to stave off a deep recession. The true danger is how this energy shock intersects with two massive, highly leveraged vulnerabilities already present in the market, a compounding risk known as the three-body problem. The first vulnerability vector is the extreme fragility within the $1.7 trillion private credit market, which consists of debt financing provided by non-bank lenders to corporate borrowers. An energy-induced recession acts as the exact catalyst needed to trigger cascading redemptions, forcing mark-to-market losses on these illiquid assets. The second vulnerability vector is the heavy concentration of S&P 500 earnings that currently rely entirely on capital expenditures from tech hyperscalers building artificial intelligence infrastructure. Looking at this risk briefing on hyperscaler AI spending, historical precedent dictates that during a recessionary growth shock, technology capital expenditure gets mechanically slashed by 20 to 40%. When we model the convergence of these three stress vectors, the energy deficit, private credit cascade, and AI capex retrenchment, they overlap to create systemic contagion. The final quantitative output is a 25 to 35% catastrophic drawdown in global equities. By ignoring the game-theoretic stalemate and the physical supply deficit of the Hormuz closure, institutions are driving blindly into a mathematically predictable, multi-asset global crisis.